describe and use the context of statements of changes in equity. So we have the ordinary shares of $5 par, the share premium, the retained earnings, treasury shares, and the total. So the balance is uh, a hundred $300,000, share premium of $200,000, retained earnings is $650,000, and the treasury shares of $32,000. Uh, Here you can see that the issued 5,000 ordinary shares at $15,000. So the ordinary share there, it stated as 15 par. So I mean $5 par. So $5 multiplied by 5,000 ordinary shares is equivalent to 25,000. And if we calculated the total par there of the issued 5,000 ordinary shares and the $15,000, $15, we could get $75. So for the share premium, uh, we minus or we subtract the $75,000 to $25,000, and it will be resulted to $50,000. So here the cash declared as a $40,000 cash dividends. So it was extended. The purchase of 2,000 of 16 shares is 32,000 of treasury shares. Under the treasury shares, 32,000. So it's extended to the total. And the net income is extended, and we have this total of $1,359,000. Moving on to the book value, another per share amount. So book value per share is equals to the total ordinary shareholders equity divided by the number of ordinary shares outstanding. So the steps in computing the book value per share, first is we compute the preference share equity, we determine the ordinary shareholders equity rather, and determine the book value per share. For this example, we have used the equity section on Graber Incorporated shown in the illustration 11 to 26. Graber's preference shares are callable at $120 per share and are cumulative. Assume that dividends on Graber's preference shares were in arrears for 1 year of $54,000, $6,009 par. So the computation of preference share equity. So step 1, we should know the preference share equity. So the call price is, the callable price there is $120. So we multiply it to the shares, which is the 6,000. So it will be resulted to $720,000. And the dividends in arrears is the $600,000. Shares, we multiply to $9. So it is $54,000. So for the preference equity, we just add it up. So it would be resulted to $774,000. So now we know the preference share equity. Next is the computation of the book value. So total equity there that is given $4,810,000. So we less the preference share equity, which we computed earlier, so $774,000. So the ordinary share equity now we do have $4,036,000. So for the book value per share, it stated there that the ordinary share equity divided by the number of ordinary share outstanding. So $4,036,000 divided by the $390,000, so it would be resulted to $10.35. Book value versus market value. So for the book value, it is the difference between the ranges of the market range. So for this example, the limited incorporation, the market range is $31.03 to $22.89. So their difference is $13.38. So as follows. So for the H.J. Haynes Company, we have $7.48. The Cisco system is $3.66, and the Walmart stores of $12.79.